How investing like a snowball or a train could transform your financial life. Sounds pretty weird, right? Yes, I know, but these are the concepts that we want to talk about in this video, so let's get right into it. But welcome everyone. If you haven't done so yet, make sure to invest in the subscribe button right down below the video. Thank you, I truly appreciate it. And let's talk through this. So of course, these couple concepts, when you apply them toward your investing, it'll give you a whole new idea and application toward your investing. Because if you actually implement these couple of concepts we're going to talk about, the snowball effect and the train effect, when it comes to your investing style, you may just be able to understand the power behind investments and cash flowing investments. So let's talk through these a little bit further. But of course, I don't know your exact investing style, how much capital you have to work with, your time horizon, or any of the other details. But realistically, it doesn't really matter at this point. Let's just better understand these couple of concepts. So here's the thing, and of course, I'm going to lean toward cash flowing investments simply because I feel like this is the best way that you can build wealth and achieve financial freedom incredibly fast is through investing in cash flowing assets versus other traditional assets, maybe, or investments like maybe just straight up buying stocks, right? I mean, don't get me wrong, buying stocks can be really profitable and can be really good. However, if you throw some cash flow right into the mix, it can get even better, right? All right, so let's get into these concepts and talk through these one at a time. So the snowball effect. Everybody's heard this at some point, right? Let me help you paint the picture and apply this to your investing. So think about this as we go through this example. Think about this when it comes to investing in just about anything. Investing typically starts out very slow and very small, right? So anybody that typically starts investing starts out with a relatively low amount of money, right? And it starts out very, very slow because it takes a lot of time to build up some kind of reserves or some kind of capital based on a very small investment, right? If you only have $100 to invest in, well, it takes a long time to build up a portfolio when you have $100, right? Even if you get a 5% return, that's only $5, right? So it takes a long time in the initial beginning. But think of a snowball at the top of a mountain, right? So it's at the top of the mountain. It's very, very small, maybe the size of like, I don't know, a pencil eraser or, something really, really small. It starts out very, very small. Well, all of a sudden, that's just like how investing starts. It starts out very small and it takes a very long time to get moving. Well, as this snowball starts making its way down the mountain, right, it starts getting bigger and gaining more momentum and speed. The same thing with investments, especially when it pertains to cash flowing investments. If you're investing in cash flowing assets, as that asset or that investment starts to throw off cash flow on a regular basis, you can take that cash flow and invest it right back into maybe the same investment or more investments, right? You can start putting it out there and getting more of whatever it happens to be that you're investing in. So let's go back to the snowball now. He starts moving his way down the mountain even faster. He's moving faster, he's gaining more momentum, and he's getting bigger as he goes, right? Well, now let's apply this once again to your investing. Now let's look at your portfolio, whatever it happens to be again. You started out with, say, $100. Well, all of a sudden you're getting cash flow on that $100. Maybe it's, I don't know, $5 a month or something like that. I mean, that'd be actually pretty good. I mean, that'd be a pretty nice return, right? $5 a month on $100. So either way, let's just say after a year, all of a sudden your $100 has turned into $150, right? A 50% return over the course of 1 year. Not bad. That's pretty good. I think anybody would basically jump through hoops for a 50% return in 1 year. But let's just say that for the sake of this video. All right, so let's keep moving. Let's say after 2 years, your 150, or at the end of 2 years, I should say, your 150 turns into 300, okay? So, wow, you had a really nice return on your investment during that second year period. Well, again, as you get bigger and as your investments continue to throw off more cash flow, you take that cash flow and you reinvest it. Maybe like, let me give an example, like dividend reinvesting, right? That's something you can do when you have a dividend paying stock. You can take your dividends and you can reinvest them each and every quarter or whenever you get your payments, right? Well, that's kind of like the same thing. Well, all of a sudden that cash flow is flowing right back into more investments. You're just like the snowball. You're moving down the mountain, you're getting bigger, you're gaining more speed and momentum the further that you move down the mountain, okay? So let's go back to the snowball for a second. It's moving all the way down, right? It's about halfway down the mountain. It's huge. It's gotten huge in size because it's moved halfway down the mountain. It's picked up a ton more snow along the way. It has a lot more momentum, speed, and it's basically unstoppable at this point, right? I mean, it's not quite unstoppable, but yet it's gained a lot more momentum where it can keep moving, and there's not a whole lot that's going to stop it at this point. However, it could still hit a tree and then be totally wiped out, right? Well, that could happen. Now, here's the thing. Let's go back to the investments for a second. Let's just say we fast forward, 7 years, and you continue to get, a 50% return on your investment. Of course, that would be a huge return, a 50% or 100% investment return on your investment. But let's just say that just for fun. Why not? It's just an example. Who cares? Rather than talking about 7%, let's just talk about 100% because we can. So here's the thing. Let's just say we fast forward 7 years, right? Your initial investment, $100. Let's just say, for example, let's just say it's $5,000 now, for example. Whatever the return on investment happened to be, let's just say it's $5,000 now. Well, obviously it could be stopped now at any point. It could all be lost. Obviously it probably won't be, but you just never know. That's the thing with investing. You take on risk in an effort to get a better return, right? Or to double, or triple, or just get some kind of return on your money. Now, here's the thing. You're kind of like that snowball. It's moving faster, it's gained a ton of speed, and it's gained a lot of momentum. Now, with your $5,000, as you've been reinvesting your dividends over the course of the last 7 years, maybe you went from maybe 10 shares, and maybe now you have, 100 shares. Something like that, right? Or maybe 120 shares now. Well, again, the more shares that you have, the more cash flow that you're getting on a regular basis because you're getting paid even more of a dividend each and every quarter. Of course, you're getting paid. When you started, you had 10 shares. So you were only getting paid the dividend on 10 shares, right? But now let's just say 7 or 8 years later, you have 120 shares, and now you're getting paid your dividend on 120 shares, right? So again, you're getting speed, momentum, you're getting velocity, right? You're getting all of this behind you with your investments. So let's just work our way forward. Let's just say another 10 years go by, okay? The snowball is at the bottom of the mountain. It is huge. It's moving along, and it is literally unstoppable at this point because it's gained so much speed, so much momentum, and so much force behind the snowball. It just keeps rolling. It could roll over a tree at this point, right? Crack the thing off right at the ground and just keep on rolling, right? That's basically kind of how it goes with investments. Again, let's look at your portfolio 10 years later. So you've started at $100, 7 years in or 7 or 8 years in, you're at $5,000. And now we fast forward 10 more years. So you're 18 years into this thing, right? Now where do we sit? Let's just say your portfolio is sitting at, $80,000. I'm just throwing out a number. Let's just say $80,000 you're sitting at. And now your portfolio has gone from 10 shares when you invested with $100 to maybe 120 shares at 8 years. And now let's just say you're sitting on, 2,000 shares, for example. Let's just say 2,000 shares. So once again, your portfolio is growing exponentially faster simply because you're getting paid your dividend on 2,000 shares versus the 10 shares that you originally started with, right? And if you continue to reinvest all of your dividends, all of a sudden you're getting all that cash flow, you're reinvesting it right back into the stocks, whatever it happens to be, and then you're getting even more cash flow going forward because now you have even more shares, right? So you're kind of getting yourself into like an exponential growth curve when it comes to your investments, right? So does that make sense? So if you kind of apply this toward your investing, over time, it starts very, very slow, but over time, you get to the point where it's almost like you're literally unstoppable because you get so big, you get so much speed, and you get so much momentum behind what you're doing. It's like, hey, we're on the gravy train now, right? So kind of a cool concept. Let's apply this to a train example now too. Kind of the same as the snowball, but again, let's just run through this analogy really, really quickly. So think of a train. Right? The train's sitting on the tracks. He's got 100 cars attached to the engine, right? So how does that train get going up to 60 miles an hour? Does it just like push a button and take off in 0 to 60 in 2.4 seconds? No, not even close. it's going to take a very long time for that train to get moving and for all those cars to be in motion. It's the same thing. It is a ton of weight behind that train. So the train starts moving. The engine starts moving very slowly. The first car starts moving. Then it starts tugging on the second car. You know what? All the way down the line, from the engine all the way down to the very last car in that train, it's going to take a very long time to even get from the time that the engine starts moving until the time that the very last car starts to move. It's a very long time, right? So they all start moving incredibly slow, but then eventually they start to get a little bit more speed over time, a little bit more momentum, and a little bit more velocity behind their move. And eventually, all of a sudden, after some time, it gets moving up to 60 miles an hour. Well, at that point, get out of the way. Seriously, if you're looking at a train that's cruising along at 60 miles an hour, I hope you are out of the way, because that thing is unstoppable at that point. You could literally have just about anything on the tracks in front of that thing, and it is going to plow right on through it, right? So that is kind of, once again, the analogy behind investments. If you're like a train cruising 60 down the tracks, wow, you're amazing, because seriously, there's nothing that's stopping that thing. It is like literally unstoppable no matter what you put in the tracks in front of that thing, right? So it's kind of the same analogy. It starts out very, very slow, but once it gets moving, it has so much velocity, force, and momentum behind that move that it is like, get out of the way. I'm coming through. Move. You know what I mean? So anyway, I wanted to lay out these couple examples because if you really look at these, they're super simple examples. I get it. We're talking about a mythical snowball at the top of a mountain. We're talking about a train. I get it. It's really basic examples and concepts. I totally understand that. But here's the thing. Sometimes basic is always the most realistic way to approach some things, like investing. So if you were to approach your investing in this same way, just keep reinvesting. Take your cash flow, reinvest, buy more, turn into a train that gets to be unstoppable over time. If that is your objective, just turn into a train or turn into a massive snowball at the bottom of a mountain. It's literally going to be almost unstoppable for you, and you're going to have so much cash coming in. It's almost like, I don't even know what to do with it anymore, right? Do I keep investing, or what do I do with it all, right? And once you get to that point, man, I mean, you've probably already achieved financial freedom at that point. If you have so much cash you don't even know what to do with it anymore, yeah, obviously you've probably achieved financial freedom a long time ago, right? But either way, that'd be a pretty cool place to be. I hope this helps you out, and I hope it gets you thinking a little bit about investing and just some other creative ways to approach the space. Anyway, hope you enjoyed this. Make sure to hit that subscribe button right down below the video. Share this one with your friends, family, or social media, and go back and check out any of my other over 1,000, well, I mean, it's a couple thousand videos now right here on the channel. Actually, I don't even know how many videos I have. 1,400, 15, 16, 1,700 videos, something like that. There's a lot of videos right here on the channel. So enjoy those, and I'll catch you again in the next one.